Well, thank you so much. And indeed, my name is Berend Paasman. I'm globally responsible in DNB Bank for ports and terminal finance. And I'll talk today, I'll first start with a quick introduction of the bank, talk about some of the recent trends that we've seen on the financing side of liquid storage terminals, and then maybe also quite interesting, the challenges with the energy transition and how to finance that. But maybe very quickly, DNB is the largest bank in Norway, AA rated bank, with a global presence in all the major financial centers. And the bank tends to focus only on very specific sectors, maritime, oil and gas, infrastructure, all connected with the Nordic economy. Now within that, we've always had like kind of a niche focus on ports and terminals. So for one part that is bulk liquid storage terminals, but also container, landlord ports, and we hope to do more on the offshore wind supply side port as well. And we finance terminals all over the world. In the last 10 years, we've been active in more than 80 different port financings. But let's start with some of the trends. We've been tracking kind of financing activity to the sector in the last couple of years, and these are all larger transactions that are in the public domain. And a few observations. I mean, you can see two graphs here. The lower graph is the transaction amount, the amount of money that banks and capital markets have been providing to the sector. And the top graph is the number of transactions. So a couple of observations. As you can see, the transaction volumes reached a kind of an all-time high. This graph is a little bit, it seems to be going down, but that's 2022. But on the peak last year, there was nearly $4 billion of financing to the sector. And that has been pretty constant in the last 5-6 years. What you also see is that 2 years ago, in 2020, there were about 15 transactions, and last year it went down somewhat to 6 transactions, as probably one of the themes was that many of the sponsors took advantage of the low interest rates and refinanced their platform, whereas the year before there were a lot of smaller add-on acquisitions that was driving financing activity. Not sure if you can all see this at the back, but it more illustrates kind of some of the deals that have been done and are in the public domain. Many familiar names on this list as well. And you can see that some of the transaction volumes last year went up to kind of some over $1 billion equivalent, but many transactions in the 400-500 million range. Across different countries, many of course in the ARA region, in Belgium and Netherlands, but also in France, the US, and in Australia, large bank transactions took place. Now, maybe more interesting to talk a little bit about the trends. And one thing that many other speakers have mentioned as well is ESG. And ESG, maybe two angles to address. The first one is that in many banks and finance institutions, ESG has really become a key area of attention. So it's not just greenwashing anymore. Banks have committed themselves to bring their lending portfolios down in line with the Paris Agreement. But many banks are more ambitious, so we're not going to wait to 2050. We want to do it by 2040 or 2035. So there's a lot of scrutiny, especially on financing of fossil fuels. And even banks that take a slightly less ambitious approach, there's still more scrutiny on storage assets that store oil and gas, especially diesel and gasoline, because of the stranded asset risk. And we can all agree that, that even in the best case scenario, there will still be a good demand for these oil products in the next decade. You already, if you finance something today, and it's a 7-year financing, you already need to bear in mind what will happen after 7 years and how the outlook is at that point in time. So what is happening in 12, 13, 14 years with these fossil fuels will already start to impact the financeability of these assets. So for those of you who want to finance these assets, it's very important to have an energy transition narrative and make sure that the mix of your terminals is some chemicals, some biofuels, and not only diesel and gasoline. The other thing that we've seen happening in the market and is more and more becoming commonplace is that bank loans are getting ESG-linked pricing, and that means that the better you behave, the better you behave in ESG terms, the lower a margin you will pay on your loans. And typically this is done by measuring and tracking 3-4 KPIs, some linked to emissions, scope 1, scope 2 emissions, but also other softer social goals, UN development goals. And typically you can see that if you meet your goals, you can pay 3 to 5 basis points less, but if you are laggard, you have to pay a higher margin. Now, if you're paying 150, 175 basis points, it's 5 bips more or less is relatively small, but I think it's quite important to signal to the market and to the finance industry what your ambitions are. So it's a way of signaling. And today it's more or less voluntarily, but in 2 or 3 years' time, the market will move more and more to this being the standard. The other trend, and of course you hear about this every day and you read about it in the newspapers, is the interest rate environment, which is changing, and is changing substantially. I've picked here two kind of relevant curves, the 5-year US dollar and the 5-year euro swap, because most of the companies that finance themselves hedge themselves, so it's not so much the floating interest rate, it's more the fixed rate, the swap rate. And as you can see, between November 2020 and today, rates have gone up by more than 2%. So if you have 500 million of financing needs, 2% means like 10 million more per year. So it's a substantial difference in money. And of course, euro rates used to be minus 50 basis points. They've now moved to positive territory as well. And you will see kind of an impact on that as capital costs become higher. You'll see an impact on that on acquisition, new acquisitions, what are acquisition multiples. And also, the bar is higher for new capex projects to make sense. Then finally, some words about the energy transition and how that will be financed. I think absolutely the good news is that all the banks that you will speak are kind of interested to be part and be part of the solution for the energy for the energy transition. Banks have earmarked funds to help companies in there, and that's not only production assets like offshore wind, it's also for the storage part of the supply chain. And many of the previous speakers have talked about hydrogen storage, the gentleman before me about flow batteries, all CO2 storage, biofuels, and of course, after the war in Ukraine started, LNG has kind of gotten like a new lease of life, and there's a lot of interest there to kind of to start investing again in LNG storage or put FSRUs in ports. But the tremendous pipeline of potential deals, just judging by all the feasibility studies, is probably billions of dollars, which is coming our way. Probably it's not going to happen tomorrow, and it might take some time, but there will definitely be a lot of demand. And as said, banks are really there to help and finance that. And also, central banks are helping in the sense that, for instance, the EU taxonomy rules were published, and the storage of chemical energy carriers is also one of the elements that is seen as green in the EU taxonomy. So theoretically, that should lead to a lower capital cost for banks and thus lower margins for borrowers. But before it is there are some specific issues on the financing side, and the first one is really size. If you want to finance a project, you need to have a certain size to do it kind of efficiently and use non-recourse bank financing. You need to pay consultants to work on due diligence reports, their lawyer fees to be paid. So if you have a pilot project of $20-30 million, it's more efficient to use equity or corporate means for that. And for bank financing to become efficient, you'll probably need more projects in the size of $80-100 million. So, but that's coming. I mean, we see like pilots are kind of scaling up, and the larger projects are probably coming our way. The next challenge then is that bank financing is quite a conservative form of financing. It's not venture capital. Banks take usually kind of the lower risk tranches. So there's certain things that are kind of difficult for banks to accept, like new technology risk. If you're kind of suddenly building a 1 gigawatt hydrogen storage facility which has never been tested, there are considerable risks on operational cost, on lifespan, on how it will be built. Will it be built with delays? So that needs to be addressed. Some technologies, like for biofuels or ammonia tanks, are actually existing technologies. But there's another issue that needs to be addressed. That's demand risk, because if you're building pressurized ammonia tanks, which can be costly, on a 3-year contract, you're taking the risk of recontracting. And who knows what the new market standard will be, whether it will be ammonia, methanol, LOHCs, or another carrier. So that's also not a risk that banks are willing to take, and it's very hard to kind of repay a loan in 3 years. So kind of the discussions that will take place and elements that you will see in deals that will be coming to the market are probably a combination of the following. You either need to see kind of quite long-term offtake contracts over 10, 15 years with very strong counterparties, so that banks can take the counterparty risk to finance it. You probably see higher requirements for sponsor equity and quicker repayment of these loans. Government support, I mean, it's being worked on. Governments are looking into these schemes. There's the European Investment Bank that is working on specific tools to help refinance, to finance this. There are ECAs, and ECAs are export credit agencies. So if you're buying a tank from Finland, you can use Finnvera, the Swedish ECA, who can provide some sort of a cover, and that makes it easier for commercial banks like ourselves to finance under that cover. Or what you will see, especially in the beginning, is that these projects will be more financed with like general corporate capex facilities that have like a multi-purpose use, or corporate guarantee, because at that stage banks are no longer looking at the specific characteristics of your ammonia tank project, but they will be looking at the credit strength of the parent, which might be more diversified. Now, it is an kind of an evolving area, and there will be quite some innovation in this part, and new solutions will be found, because if there's a financing need, banks will be there, but it's an evolving field as well. And we hope to be part of that solution. That brings me to the end of my presentation. I'm not sure if you have some time for some questions out of the room, or otherwise we can also discuss it in the next panel session. Niels.
Well, thank you, Berend, for the very interesting presentation, and I recognize quite a lot from our recent conversations on this topic. What I'm interested in is, look, banks traditionally don't only have a role as funding these type of projects, but also bringing parties together. And one of the risks you identified is demand risk, and I would think that a bank like DNB would be excellently positioned to bring parties together and almost act like a broker in this. Would you be able to play a role like that as a bank, or do you think that would be out of scope considering regulations on banks?
Yeah, so the question is whether we can bring parties together to maybe help push kind of the risk appetite of other banks to a level that you can finance these deals on a club deal basis. To a certain extent, the answer is yes, but still, it also depends on the underlying business case, because if it's 5 years, again, like, will it be ammonia? Will it be methanol? We probably do not have a better view than yourselves or market consultants, which of these evolving technologies will be the winning one. But it can help if you already have like a 10-year contract and you need to take a little bit of recontracting risk. Those are the moments that kind of that you can help and that we can help and push a bank group accept the risk.
In your earlier slides, you mentioned about the 4 billion investments in the terminals, and out of the 23 projects, what percentage are related to the fossil fuel, and what percentage to renewable and hydrogen?
Okay, most of if we go back to the deal. Most of these companies are kind of in one way or another diversified. Some companies are still more traditional and have like a higher percentage of like the fossil fuel that they store. But actually many companies have been making an effort in the last couple of years to change the mix and come down from just being kind of an oil product fossil fuel storage company. None of them is a pure kind of green fuel company. I mean, there were some transactions in the market that the methanol terminal was sold and was bought by another platform. That methanol can be made in a green way. It can be made through kind of as biofuel. It can be made like kind of in a more traditional fossil fuel way. So it's all a mix, but the trend is there that people are moving away towards like bigger shares of green storage in their portfolio.
Thank you. As one of the other speakers was talking about the new terminal projects being outside of the traditional hubs, especially those for new energies. How do banks look at, let's say, these new countries like Middle East, Brazil, Northern Africa, and how do these risk premiums factor in all those details?
It's a good question. There is an element of country risk. Most of the banks that are active in this field have more an OECD focus. So they will look at projects in the Singapore Straits. They will look at projects in Europe and in the US, especially in the Houston area. But as you rightfully say, there is more and more a need for these projects as well in places like Brazil, where you have specific banks who have Brazil in their strategy. You have issues like withholding tax, or you need to be on the ground in Brazil. You have issues with the currency. Not all banks can fund in reais, and not all projects in these countries are in dollars. There's a part to play for development banks. You have the IFC and the IDB. They have been 10 years ago, they were quite active when you had this wave of container terminals that were being built in Latin America, Asia, and Africa. So I expect that they will also be more active in these parts to mitigate the country risk and allow commercial banks to come into some of these projects. But if you go further down on the risk scale, then there are some countries of Africa with a tremendous which have a tremendous opportunities in these countries. But if your country rating is single B, then it will just fall outside of the strategy of many banks.
Hello, my name is Chris van der Beek. I represent an oil and gas consultancy company called Berend. We also help small players, because we see many small players now who step into the energy transition world, or companies who have not done that before, like tankage companies. So my question is, how do you see that risk of those type of companies? Would you finance an EFOS project? Or what does it take for a bank to say, well, we see a step out for a company to do something new, and what does it take on assurance for you to make such a project happen?
Okay, you can have a very long answer to that question, but I'll try to take out some elements. Of course it's easier for banks to finance an existing platform. You mentioned EFOS or LBC, where you have diversified locations, diversified products, and established credit metrics. And then it's easier to give another 50 to 100 million credit line to that corporate. You don't really need to go into the details of the project, because you just rely on the strength of the parent. So that's a benefit that larger companies have. So, and it's an issue that smaller companies face. How do they get their financing? So for sure, you won't have the same universe of banks that are available. You might see maybe one or two local banks that can help out, and the conditions will be different. So they will be they will get like lower leverage and have to pay higher margins as a consequence of that.
You mentioned earlier about the EU taxonomy for sustainable investments on one of your slides, and that storage of certain sustainable products was included in that.
Yeah.
If I look at discussions in Brussels right now about gas storage, natural gas storage, and increasing strategic stocks of fossil fuel products, what are your views on let's say the ability from your sector to finance projects that are in non-sustainable areas, but still areas that are critical to national security, defense, and so on?
Again, a very relevant question, and I must say I hadn't thought that there would be so many questions, but which is good. But for sure, I mean, after the kind of the start of the Ukraine war, energy security is completely back on the agenda. And yeah, you'll see kind of a little bit like a differentiation between banks. There are certain banks that say, no, from now on, we will just focus on the energy transition. We will say goodbye to oil and gas. We won't finance any new oil and gas companies, no new developments. And then there are other banks, and DNB is one of these. We say, well, okay, well, we need to help our existing clients kind of through the energy transition. And examples of that are also not so much on the storage side, but on kind of the upstream side, that we help companies in the North Sea electrify. So they don't have diesel engines anymore. So the production of oil and gas becomes greener. We help them gradually shift their portfolio away from oil and gas to more hydrogen, CCS initiatives. But this is a little bit where you see banks parting ways.
So falling out of the taxonomy scope is not completely a barrier to being investable.
No, and the full effect of the EU taxonomy, I mean, it still needs to be implemented. And the EU, and it could very well be that people take a shortcut and they say, well, from now on, what we will do is we will just only focus on the EU taxonomy and we will leave the rest aside. But I think that will only be kind of, a percentage of the banks. I think that most banks will still see and understand that there's a large part of the economy which does not fall immediately in the EU taxonomy rules, but which is still needed. And they also need to go through a capital-intensive transition. So there will be significant banks left over available to finance that, is my view. But it might be that that there's a higher price tag to that than for EU taxonomy compliant projects.